Do you ever wonder why some traders seem to enter at exactly the right moment while others keep getting stopped out? Most traders lose money not because they're using the wrong indicators, but because they're using the right indicators the wrong way. RSI, the Relative Strength Index, is a very good example. What if I told you that everything you've learned about RSI might actually be setting you up for failure? Because the widely taught conventional way to use RSI is oftentimes the wrong way. Hi everyone, I'm Lien, and I've been trading the markets for over 2 decades, starting on the trading desk at JPMorgan Chase on Wall Street. In this RSI masterclass, I'm going to show you what RSI is, why it is so powerful, and how to properly read RSI and avoid common mistakes. I'll walk you through step-by-step how to trade my RSI strategy, real-world trading examples, and advanced tips to maximize your results. By the end, I hope you'll have a complete framework to confidently trade with RSI and avoid making amateur mistakes. Now, some of you may already know the basics of using RSIs, while others might be learning it for the first time. But what I'm about to share may completely change the way you think about the Relative Strength Index. The Relative Strength Index is a tool that measures how fast and how strongly a price has been moving. It gives a score between 0 and 100 to help identify when the market may be overbought or oversold. As a rule of thumb, an RSI reading above 70 typically signals an asset is overbought or overextended and potentially due for a pullback. On the other hand, a reading below 30 suggests that the asset is oversold and may be due for a relief rally. Anything between 30 and 70 really doesn't matter to most people because it's considered normal price movement. But here's where most traders get tripped up. Just because RSI says something is oversold or overbought doesn't mean it's ready to reverse. In many cases, there's a good reason why price is moving strongly in that direction. It could be the company's earnings came in much worse than expected, or the central bank signaled more aggressive rate cuts than the market had predicted. As a result, the stock or currency dropped sharply. And in many cases, that move can continue much further than most people expect because there's a reason for it. Also, the levels between 30 and 70 may be the most valuable levels for RSI trading. But that's why trend trading is so popular amongst experienced traders. They understand the best way to make money is often to ride the trend, not to fight it. For example, in a market crash, prices can fall much faster and much deeper than anyone imagines. So trying to catch a falling knife just because RSI dips below 30 is oftentimes the wrong move, especially if you're a day trader. So let's take a look at some charts to truly understand what this means. Here's a 15-minute chart of euro-dollar. Here you can see that the RSI rose above 70 into overbought territory. And if you sold the first candle close above 70, you would have actually sold euro-dollar around 115.55. Take a look. It shot up above 116.30 in a matter of hours with very little move in your direction. Any trader using RSI this way is making a big mistake. Now, let's see how we can turn RSI into a simple but powerful trading strategy that works in any market. But before diving in, do me a quick favor, please. If you enjoy trading content like this, hit the subscribe button and drop a comment below. It helps me know what kind of content you want to see more of. Most people focus on just the 70 and 30 levels in RSI. But like I said, what's between 30 and 70 can be more valuable. And I, in particular, like to trade off of the 50 level. Instead of selling arbitrarily when RSI rises above 70 or buying when RSI drops below 30, here's what I like to do instead. And let's take a look at some live charts for a real example. So let's start by adding RSI onto our charts. So you click on indicators and let's type in RSI. And we'll add on the Relative Strength Index. The Relative Strength Index has a couple things. The first thing is that we've got the 70 level, which is marked as overbought, and the 30 level, which is marked as oversold. There are also 2 lines. We have one line that's more active, more volatile. That's the faster line. And then we have the smoother line, which is the gold line. I like to focus on the wilder movements, if you'd like to say that. Okay, so how does this setup work? Well, the first thing you want to do, let me get my arrow going, is you want to look for RSI to drop into oversold territory if we're looking to buy. So step number 1 is to wait for RSI to drop below 30 into oversold territory. But just because it does that does not mean that we buy. Instead, we actually find more benefit by trading within this no man's zone. What we want to do is we want to wait for RSI to rise and close above 50. And this is a 4-hour chart. So RSI rises and closes above 50 right here in the gold, which is right here. So the reason why this is so valuable is imagine if you basically bought gold when RSI dropped below 30. Yes, it rebounded the next day, but then went back down. That actually made a new low. And at that point, you may actually be doubting your trade because you may be thinking, okay, made a new low and maybe it's going to start to break lower. And that's why, just simply trading when RSI drops below 30 is not the most effective way to find entries using RSI. Instead, we buy here. We buy when the market's already beginning to turn. We get a close above 50, and at that point, gold is over here. Your stop should be at the swing low. And then you ride the move for 2 or 3 times risk reward. You can also add in, for example, a simple moving average, like let's say the 20 SMA. And that could also be something that you use to trail your stop. So maybe you stay in this trade until it drops below the 20 SMA and your the initial stop is the swing low. So let me recap this again. You want to wait for RSI to drop below 30. That's when it's on your radar, but we don't trade yet. Wait for RSI to rise back above 50 on a closing basis. And so we see that happen here. And look, we're also above the 20 SMA, which is wonderful because we have moving average clearance. We go long, your initial stop is down here, and you can stay in the trade until it closes back below the 20 SMA. And you can see this is a very nice, generous move. You can also use 2-to-1 risk reward, 3-to-1 risk reward. The short trade is the opposite. And we actually have an example of the short trade right over here. So here we see RSI go above 70. And if you sold RSI as soon as it went above 70 over here, guess what? Wrong move, because gold continued to rally. So simply trading RSI in the textbook way is the wrong way to trade, because if you sold it as soon as it rose above 70, it would have just basically moved against you and was a loser right from the onset. And that's the problem that a lot of traders have. Instead, what we do is we wait. We wait for RSI to drop below 50. So RSI drops below 50, and I'm going to move my trade over here. That's when RSI drops below 50. So you sell, RSI drops below 50, stop over here. So at this point, it's a quite narrow stop. And then you can use 2-to-1 risk reward, or you can trail by the 20 simple moving average and gone out somewhere around 3,000, the 3,000 mark. And that's how we look for better entries using RSI. Not by focusing on the 80-70 mark, we do pay attention to it, but we wait also for the RSI to drop below 50. I want you to really understand what's happening here and why this approach leads to better entries. We're using RSI the way it was designed, basically to spot overbought and oversold conditions and to help identify potential tops and bottoms. But instead of trying to predict those turning points, we're waiting for something crucial, for the market to actually start turning first before we enter into a trade. We're not guessing where the top or bottom might be. Instead, we wait for the price to stabilize and begin moving in our favor before getting in. This approach incorporates some very powerful trading principles, which is trading with the trend, buying into strength, and selling into weakness, and most importantly, waiting for confirmation rather than blindly entering just because something looks overbought or something is oversold, even if the RSI is telling us that it is the case. This strategy is suited for swing traders looking for casual setups of 4-hour charts. We looked at the example in gold, but I also want to show you some examples in currencies. So let's go to the live charts. Now let's look at some examples in currencies. We're going to start with the euro-dollar. With the euro-dollar here, the first setup I see in this chart is right over here where we see the RSI rise above 70. But instead of selling, which, actually this would have been a legitimate trade, what we want to do is we want to wait for confirmation. So wait for RSI to drop below 50. And this is great because we actually are also seeing RSI drop below 20 SMA at that point. So you sell here, you stop over here. And in this case, trailing at the SMA doesn't give you much, but hopefully you use 2-to-1 risk reward. You would have sold around 113.30, and the low in this trade was 112.10, so over 100 pips. So hopefully when it moves 100 pips, you have taken some of that in your favor. And here's another example. Here we get into oversold territory. And remember, right over here in the euro-dollar, if you sold right here, which was basically this candle, that would have sold off further against you. Instead, what you want to do is you want to wait for RSI to close above 50, which would have been this candle over here. And the trade would have taken its time, would have consolidated event, but eventually we test this stop. Eventually became a very, very beautiful, prolonged long trade. It also works nicely in dollar yen. Let's see, dollar yen, we've got a short trade here. Now this, the RSI would have been the perfect entry, but we sometimes, it works as a initial entry, but oftentimes, it also using the 50 as a parameter is a much better way to trade because it saves you from losing trades. So we would have sold when RSI dropped below the 50 level, which is over here. So you would have sold here. And once again, this is a trade that worked out very, very nicely. You would have sold basically around 143.77 and it dropped over 120 pips in dollar yen. So that is also a very, very nice trade. Here is a long trade. We dropped below 30 over here in dollar yen. And, and instead of just buying and then having to be tortured by this consolidation, we buy over here on the close of this candle, which is really nice because you get a confirmation from RSI and you get a confirmation from the moving average. Go long and it starts moving your way right away, which is what we want because it's a very good feeling with trades that start moving right away. Is the confidence that's built in it. So you go long here, 143 and change, and it goes all the way above 146.20. Together, we've seen some really good examples, but remember, no trading strategy is foolproof, so risk management is key. Also, using RSI together with trend lines, moving averages, or candlestick patterns can help increase the accuracy. RSI works best on markets with volatility like indices, Forex, crypto, and commodities. And for this strategy, it works better in markets that are moving, not consolidating. So don't be trying to use this on a very tight currency pair, for example. In an earlier video, I talked about how much I love moving averages and how I love to look for moving average clearance. It's important to incorporate that when you're using RSI or any indicator. Just take 2 or 3 extra minutes before you place the trade to make sure that you're not selling into moving average support or buying into moving average resistance. If you want to learn more ways to turn technical indicators into trading strategies, type more or more strategies in the comments below. And if you found this video helpful, make sure to like this video, subscribe for more trading lessons, and join my trading community using the link in the description below where we share tips for trading every single day. Thanks for joining me today. I'll see you all next time.